Welcome, everyone. Welcome to another episode of Be the Boss of Your Money, because I want you to be the boss of your money, not your money to be the boss of you. We've got a very special show today. It's about my market dashboard, something that I look at day in and day out that tells me a lot about the market, the economy. I could take one glance at this dashboard and it tells me so many things. It's just like I don't have to look at how just the Dow is or the S&P 500 or the NASDAQ composite. I look at my dashboard. To me, it's a much better indicator of what's happening in the market than anything that you could get from looking at the major averages, which really, in my opinion, don't tell you all that much. They very scratch the surface. They don't tell you the internals. They don't tell you what investors are thinking. So let's get into this. We're going to start the introduction, and we've got a few things to cover. And then we're going to get into my market dashboard, which consists of 11 exchange traded funds. I'm going to share each and every one of them with you. I'm going to let you know what they do, what they are, and we're just going to rock today. Okay, so let's get into the intro, and we've got a few things to talk about. Well, hello there. Welcome to another live episode of Be the Boss of Your Money. Just working the controls here, and I'm going to kick back, get rid of the email alerts. Okay. So I'd like to welcome you to the live stream. And if you're out there watching this and you have a question, feel free to ask me in the comments. I would love to answer your questions. We talk about investing, personal finance, business, and you can ask me anything about any of those subjects. I would love a shot to answer them, even if they're not exactly about what we're talking today. I'd also like to welcome you if you're watching this in the replay. So thank you for taking the time to watch. I know a lot of you, probably most of you, watch this in the replay. So if you do have any questions, go ahead and ask in the comments as if you were watching during the live stream. I will check for those. I get the alerts. So I want to get back to you on those. So again, my name is Mitch Goldberg. I'm a financial advisor. I'm with the wealth management firm Client First Strategy. I named it Client First because when I decided to open up my own firm, it was all about putting the clients first, not manufacturing any products or gadgets or anything. It was just to put the client first. So I came up with the name Client First Strategy, creating strategies for investing, planning for you. So if you have any questions, certainly give me a shout. If you'd like to reach out to me directly, hit me with a DM, email me, or call me. My email and phone number are in the scroll you could see scrolling by. So definitely ask. We're going to just do a quick screen share. This is something that if you watch this show, I do this basically every day. So I'll do a screen share. We'll go through a quick market wrap, but not just a market wrap that you can get from anywhere, something that gives you perspective so that you could see what we're talking about. So I'm just going to make the screen a little bigger so that when we get into it, we are ready for it. And here we go. All right. So you see here, Dow down about a little over 100 points, S&P down less than 1%, NASDAQ down just about 1%. The Russell 2000, that's a small cap index. You know, if you're a regular viewer of this show, I've been talking about the Russell 2000 small cap index, that it's been such a laggard compared to the other major averages, and it seems to be catching up. You know, it seems to be closing the gap between itself and the other major averages. So that actually held up pretty well today. And the VIX, we have the VIX up a little bit, still under 50. That's the fear gauge. That's 29.53, up about 5%. By the way, that's a typical day. That the VIX can move 4 or 5% easily in a day. It typically has much more exaggerated moves up and down than the major averages. The VIX doesn't track the major averages. It tracks its own gauge of fear, you know, as they call it. So we want that to go down, and I like it under 30. Was in the mid 80s. Late in March, we were at the bottom of our current market malaise. Okay, so let's go on to market movers. We'll take a look at some of the big winners in the Dow. Here's something you don't see too often. Boeing, the biggest winner in the Dow Jones Industrial Average, up over 4%. Raytheon, Travelers, little move from Nike, Home Depot, McDonald's, and everybody else just contributed to losses. IBM being at the bottom of the pack. And we'll take a look going forward for the Corona list of stocks that I cover. All right. I know we've got a couple of people out there for comments and the like. So we've got Russell out there and Kathy. I'm going to get to you guys in just a little bit. I just want to move on with the show a little bit. I'm going to hit you guys with some answers, and I appreciate your questions out there, Kathy. So thank you very much. Russell, you're always out here. I really appreciate that. Okay, Zoom was down about 2%. Clorox down a little over 2%. Activision. Peloton was up slightly. Domino's, Campbell's, I call these, the stay-at-home stocks or the coronavirus stocks. So, they gave back a little bit. That's to be expected. These are some stocks that had very big runs. It's kind of strange to see Clorox. Well, not strange, but Clorox is under $200 again. I don't know if that really is a harbinger of anything, but to me, some of these stocks do look, a little tired. That's all. They're just looking a little tired, and we, I think the work from home, social distancing stock thing for a while is looking like it's starting to take a back seat and give up leadership to other sectors. And then we'll take a look at the another watch list I have set up, my FANG M stocks. Okay, out of these stocks, Facebook made a new high. By the way, yeah, these are closing market, not extended market. So Facebook touching a new high, and that's terrific. A lot of people doubted Facebook a few months ago when it was in the mid 100s. Apple was off. Amazon was off after hitting a record new high yesterday, off $51 a share. But again, it's a 2% move. Keep in mind, Amazon is a $2,400 stock. Netflix, Google / Alphabet. It's Alphabet. And if you don't know and you happen to not realize this, Google changed its name to Alphabet. Google is just one division of Alphabet, albeit the biggest part, the search engine. And Microsoft, generally speaking, I'm surprised right now that the market, the NASDAQ was down just about 1%. So not surprising that when these FANG M stocks, 6 stocks, when they don't have a good day, they typically pull the market down. And when they have an up day, they typically pull the market up. So they're kind of like the bullies of the stock market. Okay, so we're going to stop sharing there, and I want to go into the heart of what we're talking about today. So let's stop sharing this. Share screen. I've got another screen to share, so we'll be better. We'll be better with that. Okay, so today I want to talk to you about the dashboard that I use. One of the things that I talk about every day is how the sector ETFs did. I show them in energy, industrials, financial, and every day I like to call it out and say today was a V-shaped day, or a U-shaped day, or a W-shaped day. W is like when the economy and the market go down, they recover like a V, but then they do it again, and then they come back again, and and if they keep doing that, it goes from a W to a sawtooth pattern, and you've got a we've got sometimes you have a V-shaped day, and sometimes you have a U-shaped day. So it changes day by day, but I like to take a look at that. It's kind of fun for me. And I'm going to take this off because I feel like there's a little echo in here. And it's not only is it kind of fun for me, but it's kind of gives you a description of what people are thinking each day. So let me start by saying this. And if you have any questions out there, certainly give me a shout, and I will be happy to take those questions. We like to categorize stocks. We here in Wall Street, we categorize stocks like crazy. And you've got all different kinds. Well, whoever's trying to call me is really, I don't know the number. So it's over and over. So whoever, we categorize stocks, we have restaurant stocks, we have airline stocks, we have food stocks, heavy machinery stocks, we have tech stocks, we have alternative energy stocks, we have all kinds of stocks. We really like to categorize all of our stocks. It gets to the point where you can split them, any way you want. Okay. List that description of how you came up with the name. Okay. I'm going to have to ask you about that. Okay. So, chevron pattern, LOL. Okay. Um, so one of the things that we do is we categorize stocks, but one of the main ways to categorize stocks is the General Industry Classification Standards, GICS. Some people just call them GICS, GICS. So Standard and Poor's starts by classifying stocks with 11 major industrial sectors, industry sectors. Okay, so that's how they do it. So they start by doing that, and then from there they break them down into further categories. But the main ones are 11 of them. And what you do is I take a look at these to see which ones are leading every day and which ones are lagging every day. And the winners tell you something. So, for example, when it's a V-shaped day, meaning investors are bulled up, they expect positive things to happen in the economy, and they're excited about the stock market, and they're expecting, let's say, to come out of this social distancing economy pretty quickly, and we're going to come out of the recession, and the states are reopening, and there could be a new, a possible drug or a vaccine. Then people go into the economically sensitive stocks like industrials, energy, and financials. And I point those three sectors out every day because if they're not leading the market, to me, it's a negative. And if they are leading the market, to me, it's a positive. It's a positive on the economy, a positive that we've got some maybe new leadership in the market besides the same stocks, just Amazon and Netflix and Microsoft, et cetera. And then we have consumer staples, healthcare, and utilities, which typically do well when we are going into a U-shape or an L-shape kind of economy where we think things are going to stay bad with a recession. We're going to remain in the recession, and we're not going to come out of it, or it's going to take a much longer amount of time to come out of the recession, or the recession gets worse. Because when you see consumer staples go up, consumer staples, for example, they make things that you need, not necessarily that you would want. Consumer staples would include food, laundry detergent, disinfectant soap, disinfectant wipes. So Clorox is your classic consumer staples company. A company called Hershey, Mondelez, General Mills. Okay, these are consumer staples. And then you have utility stocks. You know what a utility stock is? You pay your electric bill, you pay your gas bill. These companies, you use them through thick and thin. They're very heavily regulated, but utilities are known for paying out some decent dividend yields. All right. And then your healthcare stocks typically do well also in a recession. Not so much that they could do better. Same with consumer staples and utilities, but typically their earnings and their revenues don't go down as much in a recession compared to, let's say, industrials, financials, and energy stocks. So their earnings and revenues hold up better. So when you see those 6 sectors swap the leading position over and over, it gives you an idea of what investors start to think. And when they start to hold a pattern, like you start to consistently see industrials and financials lead the way, that tells you that, hey, maybe investors are anticipating a better economy. The stock market's anticipating a better economy, because usually the stock market is ahead of the economy. So the stock market tanked before we got into the worst of this recession, and before we got into the highest rates of hospital admissions, ICU admissions, and deaths from COVID-19. And then we're in the thick of that. The stock market actually started to go up. When we started getting the worst numbers of GDP and employment figures, people are asking, why is the stock market going up? Because stocks typically trade in advance of the best and the worst news. Okay, so I'm going to go over these with you, and I know this is going to be a lot. I'm going to make this quickly because I'm going to give you the exchange traded funds, because for each sector, for all of these 11 sectors, there's an S&P. There's a Spiders from State Street. There's a Spiders ETF. Spiders is S&P depository receipt. So State Street, a big financial services company, manages these very popular exchange traded funds. Okay, so let me just move my screen over, and we're going to do the share screen now. We'll just take you through the overview. By the way, I want to just say a quick word about these. They all have the same expense ratio, 0.13%, so 13 basis points. These are stock investments, so they should be treated as investments. They are subject to the risks of the market. They have their ups and their downs. They all have their own characteristics, and they all face some very similar risks, and they all face some of their own unique risks. So without further ado, I'm going to just go through these, and I'm going to do this pretty quick. So pay attention. Okay, here we go. I'm going to make these a little bigger so you can get a better view, because you're probably watching this on a smartphone. Okay, I'll make this as big as I can without losing the gist of what we're looking at. So the communication services ETF, okay, select sector SPDR is XLC. The symbol is XLC, and you think communications, you think that's all going to be AT&T and Verizon. They are in this ETF, but they're not even in the top 10 biggest positions. But in it is Facebook, Alphabet, and Netflix. So 21, 32. So you're talking a third of these, of the stocks. Okay, more than a third, because you have two classes of Alphabet. You're talking like 40% plus, close to 50% are in a couple of FANG names. Okay, so just to give you an idea of what we consider communications. But when this sector is doing well, its communications are typically considered in that realm of not recession proof, but they're somewhat recession resistant, because people use their communication services through thick and thin. So they're not it's tough to get rid of those. And then you have the XLY, which is consumer discretionary. Let's take a look at those. That's Amazon, Home Depot, McDonald's, Nike, Starbucks, Lowe's, bookings, it's travel, TJX, Target, Dollar General. The thing that you should notice about these companies is that consumer discretionary typically make things that you want, not that you need. So you need laundry detergent, you need toilet paper, you need toothpaste. But, you know, a lot of things like Nike sneakers and Starbucks coffee, these are not needs. You just want them. I know if you want something badly enough, it does become a need, but these are, you know, those are not needs. This is just as an example, okay? Like Tiffany jewelry, for example. Okay, Michael Kors bag, that's not a need, it's a want, as you know. But if you look, almost 25% of this ETF is in Amazon, 12% is in Home Depot, a lot of it is in a few other concentrated stocks. So again, it's a pretty heavily weighted, 25% in Amazon. That's pretty big for any fund, any stock fund, mutual fund or exchange traded fund. But that's the nature of the way these sector indices are. And Amazon, I know, and I want to point this out, Amazon is a funny creature, because Amazon could also be considered consumer staples, because they sell things that you need also. You order paper towels and toilet paper, things like that from Amazon. You order food from Amazon, and food's considered consumer staples for the most part. But they sell you things that you want. It's also a tech company, because they have Amazon Web Services. They're the biggest cloud computing company on planet Earth. So a lot of companies can fit into more than one category. But what State Street does is they say, well, the main category for that company is what we go by. And then you have consumer staples. Here are the things that we need. Procter & Gamble is almost 16% of it. Pepsi, Walmart, Coke, Mondelez. Mondelez makes Nabisco, for example. Altria, that's the old Philip Morris. Costco. So like Costco sells things you need, but they also sell TVs and other luxury items. Costco sells jewelry. So just to get into that, the next one is energy. Energy has been on a tear lately. Energy, went to negative for a very brief, short amount of time on a tiny bit of futures contracts volume. But oil is, from a barrel perspective, has gone from single digits to over 30 in like the last 2 or 3 weeks. So oil is starting to go up. Gasoline usage in the United States is starting to climb back. Still not to the point where it was before the social distancing started, but it's climbing back pretty quickly. And you can see here, just Chevron and Exxon are, 43% of the portfolio. 40. Okay. So, but that's energy. So when you see energy doing well, it means people are driving more, they're going to work, trucks are moving, airlines are flying, trains are moving. So that's a good indicator when you see the price of oil go up and you see energy stocks do well. You might say, well, how's that a good energy paying more at the pump? I mean, how's that a good thing paying more at the pump? Look, we don't want to pay too much for gas at the pump that it kills the economy, but we don't want to pay too little either, because that tells you that the economy is extremely weak. And then you have the financials. The financials, to me, are the most important sector that I follow. And you have Berkshire Hathaway, that's Warren Buffett's company. That's like an amalgamation of other financial services companies. He's a big shareholder of Wells Fargo as well. He's got, there's JP Morgan, there's Bank of America, BlackRock, S&P Global, the CME, American Express, Goldman Sachs. When the financials are doing well, that means typically people are spending money. Money is moving. There's more velocity of money. That's what we call money moving, velocity of money, and how quickly it moves. And we also want to see financials do well because it means there's more lending going on. There's more loan origination going on. So that's a big thing. What hurts the financials is if interest rates are too low, they don't make anything on their net interest. They make very little on net interest margins. I'm talking about the banks. Net interest margin means the cost of money for the bank, and then they have to pay you interest on your deposits. What they want to do is they want to pay you less than their cost. But if their cost is and their of money and what they have to pay to you, if it's too narrow, they don't make any money. So that hurts the banks when interest rates are too low. So it's a big risk there. I've got a few people out there watching. I'm going to get to your questions. Emily, I see you're out there. Hey, Jess, love you too, sweetie. Healthcare. So healthcare, basically, it's Johnson & Johnson, United Health, Pfizer, Merck. These are typically recession-resistant companies. These companies basically, your health doesn't take a break, whether if we have a recession or not. Now, granted, there is some funky stuff going on right now with the COVID-19 and the pandemic and all that. But basically speaking, people will continue to take their medications through thick and thin. People still go to doctors. People still get sick. So generally speaking, healthcare companies' earnings and revenues hold up better in a recession because they're not so economically sensitive. And then here's a real economically sensitive sector is industrials. So you've got Union Pacific, Honeywell, Lockheed Martin, 3M, Raytheon, Boeing. Boeing had a real good day today. By the way, if you want to talk about a good index to follow, people talk about the three main averages: the S&P 500, the Nasdaq Composite, and then there's the Dow Jones Industrial Average. You can invest directly into an index, by the way, but you could invest in a security that tracks or mimics an index. Just have to get that out of the way. But the Dow Jones Industrial Average is really not an industrial index. There's Disney, there's United Health, there's Johnson & Johnson. It's not as industrial as the name would imply. If you want to track the real industrial average, you want to follow this. XLI is the symbol, the Spiders Industrial ETF. This is a much better gauge to track the industrial part of the economy. You have building materials. Okay. Some people think energy should be considered materials, but it's not. It's a separate category. But you've got companies like Newmont Mining, Air Products and Chemicals, Ecolab, Sherwin-Williams, DuPont, Dow Chemical. You get a lot of chemical companies in this space. Okay, very, very economically sensitive. Real estate. Okay, so American Tower, they own towers with cell phone base stations. So that's really a play on like 5G and the use of cell phone data going back and forth. They own towers. Prologis is a REIT. Crown Castle is similar to American Tower. And you've got a few other types of REITs: Avalon Bay Communities, Public Storage, Equity Residential, Welltower. Interest rates. when interest rates are low, it helps REITs because they have dividend. Typically REITs pay big dividends just because of the way they're structured from a corporate tax perspective. But low interest rates help because their dividends become more valuable in a low interest rate environment. So that's a good thing for REITs. So people want to attract them more. But on the other hand, if you have a lot of, let's say, office REITs or industrial REITs, office property, for example, those might not do as well because vacancies start to come up because corporations go out of business. A lot of people are wondering what's going to happen to the office REITs now that there are so many people working from home, and it's turned out that it's actually very easy and effective to work from home. We're rounding it out. We've got two more. Technology. So if you want to follow technology, Microsoft and Apple are over 40% of this ETF, but they also are the biggest, represented companies in the tech sector. You've got Visa, you've got Intel. I know what you're thinking. Visa, that could be a financial. It has a lot to do with financial and spending, but Visa is actually a tech company. Same with MasterCard. Alphabet and Facebook are not in the tech sector. They've been moved to communications. So it's kind of funky how this stuff is tracked. The symbol is XLK, and you want to see technology. See, technology used to be very cyclical. They would do well in a good economy, poorly in a bad economy. But now technology just seems to do well no matter what. So they've made a move to go from cyclical stocks to consistent growth companies. And lastly, we have the old boring staid utilities like Duke Energy, Southern Company, Dominion, Exelon. These companies are typically, you have American Electric Power, which I believe is the one of the biggest REIT. I think it's the biggest utility, even though it's not at the top like NextEra. But regardless, utilities are known to pay large dividends. The industry overall is very regulated. They don't just get to raise their price of their service. They have to go through all kinds of state regulations to do that. So they have less growth prospects. They basically grow more or less alongside with growth of the population of the United States, which is a pretty slow growing figure, but they do make up for that with pretty hefty dividends overall. So that's the sectors. So the wrap up for that, I'm just going to stop sharing my screen now, and then just back to me. All right. So the wrap up for these, and I'm not finished with yet, I'll get to your questions, is that when you take a look at these sectors and you see every day which sectors are leading, which sectors are in the back, there's only 11 of them, so it's not hard to keep track of them. If you keep track of them long enough, you start to get a sense, like you become very familiar with them. You start to pick up trends. That's really important. And the other thing is, if you follow them, you'll get a bird's eye view instantaneously of what investors are thinking in terms of, do they see the economy getting better or worse? So if you see consumer staples and utilities, for example, leading, in ahead of other sectors, that's kind of a negative for the economy. And if you see industrials and financials and energy leading the way, that is viewed as a bullish sign for the economy. Now, it does change a lot. It could change day to day. So this is not necessarily a long-term indicator until you start to see trends developing. I do see some trends developing. I do see that energy, industrials, and financials, to me, look like they're starting to become firmer and holding on to their gains. Now let's get to the questions out there, and I appreciate everybody who is out there. Dan is out there too, by the way. Dan, good to see you. Okay, so Russell, like that description of how you came up with the name. Is it the Be the Boss of Your Money name? Because I love the name. I racked my brain for this for a couple of days, and I also looked at a lot of other YouTube channels and a lot of other creators and see what they're doing, like Money Boss, things like that, and all these clever, catchy names. And I finally came up with Be the Boss of Your Money. I searched for it. It wasn't being used anywhere else. Okay. Kathy is out there. Should you pay your credit cards off? I only have a couple. Okay. So Kathy, the short answer, this is a personal finance question. Yes, you should. That's the short answer. The long answer is if you could. What happens is if you can't pay them off, it means that there's an imbalance between your revenue and your earnings. Now, is it because of a short term blip in the world because of, let's say, the pandemic that's going on right now? So you just needed to live on your credit cards a little bit to get through this tough time? Did you lose your job? If that's the case, then you should get back on your feet and eventually you'll get around to, paying down these credit cards. But if you're thinking about, I'm going to hold on to these balances and I could pay them off, well, you're paying probably 15 to 27% interest on the cards. And it's unlikely that you're going to make that kind of return investing in the stock market. So if you look at the monthly charge, just the monthly charge that you pay every month, it does add up to a lot. So I hope you could pay them down, and please do that as soon as you are able. And we have Kathy again. Yes, the chevron pattern, LOL. Thank you very much. I know the shape. And Emily is out there with a big question. Okay. Emily, is it Ianelli or Ianelli? Okay. So anyway, Emily, I appreciate your asking. Why does Wall Street, stock market, NASDAQ act differently from Main Street, the job market, high unemployment? During COVID-19, with nearly 100,000 deaths in big companies and small businesses going out, where the markets are up, and we're in a situation that may lead to a Great Depression with high unemployment in the economy. Economic cash markets up, where economic crash market, economic crash, market crash. Where is the market now compared to COVID-19 crash? And is it advisable to stay in the market with life savings? Okay, there's a lot to unpack here, and I think I could do a whole video just on this. So I'm going to keep that question up because I want to keep looking at it as I answer you to make sure I don't miss anything. It's actually like the ultimate question that I get asked constantly. It's a great question. Actually, I'm going to take it down because it's such a big question that it's blocking my face. But I could see it on the side over here. Okay. So first of all, the stock market actually tanked ahead of what became the worst news of the economy, and it recovered faster. But if the economy did reflect the current, if the stock market, the stock market tanked ahead of the worst of the economy and recovered a lot after. I hope that makes sense. But if the stock market truly reflected the current, at this moment, state of the economy, the stock market would be much, much lower. So people are thinking or asking, well, then why is that not the case? It's not the case because the stock market doesn't just trade, neck and neck with the economy. It doesn't trade in lockstep, where it's not valued in lockstep with the economy. The stock market is reflecting expectations that states are going to reopen and stay reopen, and that the economy will start to get back on its feet, and that we'll have a vaccine for this dreaded virus. And if that's the case, the stock market is looking past the valley that we're in toward the next peak. The other thing is, you take like your local businesses, the local florist shop that's closed, or a local bakery or something that's closed, a local clothing store. Those companies are not traded on the NASDAQ or the S&P 500 or the Dow. So this pandemic has created winners and losers in the stock market, but the winners that it's created happen to be already the biggest companies like Amazon, Apple, Facebook, Netflix, Microsoft. So more money has just gotten into those companies, and they're so big that they've pulled the rest of the market with them. There are plenty of stocks that are way down from their highs, like JP Morgan. Citigroup is down by about half. There's a lot of industrial stocks. You look at that are down a lot. You look at the airline stocks, cruise stocks. So there are a lot of stocks that are actually very reflective of the horrible, sad state of the economy right now. And there are some that are actually reflective of a Great Depression. But, the stock market is a market of different stocks. So there are some winners and there are some losers. It just happens to be the winning stocks are the big ones, which have a greater influence on the stock market. And the losing stocks, like the cruise stocks or the retailers like a Macy's, for example, these companies are so small by today's standards of what's considered a large company that they're no longer dragging the market down. There could come a day of reckoning when the stock market has to catch up to the economy or vice versa, but we are not at that day now. I hope that helps with that answer. And if you have any more questions, you're welcome to reach out to me directly. By the way, folks, if you want, I post all of these videos on my YouTube channel, Client First Strategy on YouTube. If we're not connected on Instagram or LinkedIn or Facebook, what have you, if you'd like, connect with me on those platforms as well. Subscribe to my YouTube channel. If you have any questions going forward, ask me, and I'll see you tomorrow. Thank you so much for tuning in.